One of the most popular and powerful concepts in the trading world is the smart money concept, or SMC. And whenever we discuss SMC, a topic that constantly comes up is the fair value gap, or FVG. Do you know where the problem lies? Many of us try to trade simply by identifying regular FVGs and end up taking losses. Because professional traders use an advanced concept alongside regular FVGs known as the inversion fair value gap, or IFVG. In today's video, we will learn in very simple language and through practical examples what fair value gap and inversion fair value gap actually are, what their real differences are, and how you can use them to significantly increase your trading win rate. So watch the video right until the end, hopefully you'll learn a lot of new things. Let's get into the main discussion. First, let's talk about the fair value gap, FVG. Simply put, when a large institution or bank places a huge amount of buy or sell orders in the market, price moves extremely fast and with strong momentum in one direction. This type of impulsive movement creates a void or gap between candles. This is what we call an FVG or fair value gap. To explain it in the language of Japanese candlesticks, suppose there are 3 candles. If there is an empty space or gap between the high of the first candle and the low of the third candle, where the middle candle has formed a large body all by itself, that is a valid FVG. Bullish FVG, when the market is rushing upwards and a gap is created in the middle. Bearish FVG, when the market is moving downwards and a gap is created. Traders usually do what? When the market creates these gaps and then retraces slightly downwards or upwards to re-enter the gap, which we call mitigation, they take a trade entry from there. Because it is believed that the market loves to fill these fair value gaps. Always does the market rebound from this gap? Absolutely not. Many times the market pays no attention to these gaps and breaks straight through them. And that is when the second and most important part of our discussion is born, the inversion fair value gap. So now let's understand what the inversion fair value gap, IFVG, actually is. Listen very carefully. When a standard fair value gap is broken or pierced through by the market with strong momentum in the opposite direction, that old FVG completely changes its character or properties. And this transformed version is called the inversion fair value gap, or IFVG. Let's make this clear with a practical example. Suppose you took a buy trade relying on a bullish FVG. Your idea was that the market would come to this gap and bounce upwards. But due to some news or heavy selling pressure, the market pierced downwards right through that bullish gap and moved completely past it. The gap that was supposed to act as support or a buying zone for you has now, after being broken, turned into a strict resistance or selling zone. This flipping of the gap's role or function is what we call inversion. Why is this IFVG so important? 1. It gives a very solid signal of a market trend change or reversal. 2. When professional smart money traders see that an important FVG has been broken, they understand that market sentiment has shifted. 3. Later, when the price returns to test this inverted gap, IFVG, it acts as a strong zone, and you can confidently enter a new trend there. So let's quickly sum up the differences between the two. Location and usage. An FVG is an intact gap used for trend continuation. On the other hand, an IFVG is a broken gap used for trend reversals or breakout trades. Behavior. Price rebounds from an FVG, whereas price breaks an IFVG and then retests it, reacting as support or resistance. Now, a small trading tip for you. Never blindly trade any FVG. Especially when trading on lower time frames like 5-minute or 15-minute charts, pay attention to whether the market is respecting the FVG and bouncing away from it, or pushing hard to break through it. If you see it breaking, don't be discouraged, mark it as an IFVG. Then, when the price comes back to retest that broken gap, plan a reversal trade. You'll see your win rate increase significantly compared to before. I hope that with today's video, all your confusion regarding fair value gap and inversion fair value gap has been cleared. Be sure to let me know how you liked the video in the comments. And to learn more such amazing practical concepts about Forex, crypto, or stock market trading, subscribe to our channel and stay tuned. Wrapping it up here for today. Everyone stay well, stay healthy. Happy trading.